The center is located on Treaty 6 territory and the homeland of the Métis in Saskatoon, Saskatchewan, but I'm currently joining you from the traditional homelands of the Cayuga Nation in the Finger Lakes region of upstate New York. Today, some of you might not be aware, there are Cayuga Nations and people living both north and south of the Canada-US border. And I think that perhaps as many things we can learn from our Indigenous neighbors, this can serve as a timely reminder for us that social connections and economic cooperation between people and communities, it transcends boundaries, even the legal and structural ones we've created to separate neighboring countries, Indigenous people and settlers, and credit unions and cooperatives from each other. We have a record number of people registered for today's panel, so thanks for your patience because this is the first time we're using a webinar format, over 360 and counting. Some, of course, will watch the recording after. So we had to move away from our normally more intimate conversation format to a webinar style. So we'll start with a panel Q&A discussion between myself and our esteemed guests. Followed by some time for questions from the audience. So if you do have questions for our panelists, you can feel free to submit them throughout using the Q&A function on your Zoom screen. We'll likely not be able to answer all the questions that are submitted, but we will do our best to moderate the questions to ask panelists about major recurring themes in the submitted questions. So to frame the panel discussion, I wanted to start just with a couple of basic statistics that some of you may not be aware of. In 1966, at sort of the peak of the number of credit unions in our history, there were more than 3,200 credit unions outside of Quebec and almost as many cases inside Quebec. Each one of these credit unions was small and deeply embedded in geographic, cultural, or workplace communities, and they were serving broader social objectives in addition to providing financial services to their members. Today, we have now less than 170 credit unions that remain outside of Quebec, some of which now span entire provinces or even cross provinces. I have been working on a year-long study with Marc-André Pigeon, the director of the Canadian Centre for the Study of Cooperatives, on the history and future of small credit unions, and we hope to release the paper and results in the next month or two. And one of the findings of our study is that there's a deep debate within and across credit unions about the necessity and effectiveness of mergers. And credit unions are exploring many different paths to address contemporary challenges. So to help us understand what we are calling the Great Canadian Credit Union Merger Debate, I'm joined by 4 panelists who have some overlapping perspectives as well as some differences in perspectives, and that's why we selected them. So Celina Philpot, who is the CEO of Conexus Credit Union in Saskatchewan, is joining us. We also have Mark McLaughlin, President and CEO, and Mike Bouchard, Chief Risk Officer, both from Kootenay Savings Credit Union in British Columbia. And we also have joining us Mike Schilling, President and CEO of Community Savings Credit Union in British Columbia. So welcome to all of our panelists. Thanks for joining us today. And I'm going to start with a question about mergers. There are now very few credit unions remaining in Western Canada that have not been involved in a merger at some point in their history. And reflecting that reality, I believe all 3 of your credit unions have gone through mergers, some more than others, some more recently than others. And so my first question to the panelists is why did your credit union decide to merge? What goals were you trying to achieve? And I think I'll start with Celina.
Sounds great. Thank you, Dion. So at Conexus, our thought process was, how do we drive more value for our members? So understanding that the financial services industry is getting more competitive and the expectations of our members are increasing with that desire to have more digital access and that speed of delivery that really everyone's trying to achieve while still maintaining the core of our cooperative principles is the challenge that was in front of us. So recognizing by coming together with like-minded partners and really a strong financial position and coming from a position of strength, which is what our 3 partners are. So that's Conexus, Cornerstone, and Synergy. What could we drive together collectively through coming together as a new entity? And how can we leverage that collective benefits, skills, the resources, the scale to then transform that into true member value delivery? So that was kind of that call to action. And could we do this better working together? So as true cooperatives, joining forces so that we can perform a larger role, have a larger presence within our own province so that we can make that outreach to our members. In addition to that, we could truly be a provincial credit union. So we have locations as far north as Larange, as far south as Cornac, as far east as Moosomin, and now as far west as Lloydminster, and then everything in between, so that our members really have that choice and that they can bank anywhere within our province.
Thanks, Celina. I'm going to pass this question over to Mike Schilling. Do you want to share?
Morning. Yeah, I'd love to, and thanks for having me. Well, our credit union, Community Savings, has merged. I think we think 6 or 7 times. No one can quite remember. Starting in the 70s and as recently as a few years ago, which was the one under my tenure, if you like. And those mergers have happened for a variety of reasons. Our founding, Community Savings, was founded in 1944. We had a strong connection to labour unions. We were started as part of the IWA labour union, and the mergers that we did since the 70s up to present day have largely been with other union-focused credit unions. So we found someone who was similar enough to us. And but what I would say is there was usually a catalyst. Historically, there was a catalyst, and that catalyst could be the general manager or the CEO leaving, or a board that ran out of steam, or a financial pressure on the credit union. So rather than being kind of forward-looking and strategic in nature, they were born of a necessity that was being faced at the time. And I think, that's a great statistic, going from 3,200. And so 95% of those credit unions in 1966 no longer exist as independent credit unions. And, we have to acknowledge that a number of those mergers were born of necessity rather than forward-looking strategic planning.
Thanks, Mike. That echoes some of the findings that we've been hearing, that a lot of earlier stage mergers were happening as a result of necessity and changing demographics. And now more commonly today, we're hearing that there's strategic rationale for many of the mergers that are
still happening. A mix, I would say, but yeah.
Yes, fair enough. Mark, do you want to speak? I know you're going through a merger right now.
As we speak. Yes.
As we speak.
Actually, I just got some voting updates this morning. So,
okay.
Yeah, but real pleasure.
Hot off the presses.
Yeah, thank you. Real pleasure to be here, Dion, and to participate in this. And not uncommon from Celina's comments or Mike's comments. Community Savings has and is an evolution of kind of a number of different sort of aggregated credit unions over the many years, and 57 years as we sort of head into our functional operation. They were all done for certain reasons, and at the time, certain sort of, to Mike's point, necessities around the potential of some changes that were happening, both in the leadership ranks, or the opportunity to be able to be better strategically positioned from a geographic perspective. Our embarking right now, our merger activity with Columbia Valley Credit Union, which is interesting because it's a single branch sort of credit union, but it's in a community that it actually has more members in the credit union than actual people that live in the community. And so it's got a sort of profound history, a 70-year history, and it's one of those kind of unique credit unions that's always been the credit union in that area. So it hasn't been as a result of a multitude of mergers. It has always just been kind of the golden credit union. So there's a bit of a uniqueness relative to its legacy and an opportunity. And really what drove, or what does continue to sort of drive, these types of initiatives for us is that importance of community banking. And in British Columbia, and I think the number's around 23 or 24, I could be wrong, in and around our 30, mid 30s of numbers of credit unions. We're the only game in town in a lot of these communities, and Golden is sort of, one of those organizations that we want to ensure that it's got that longevity in respect to its ability to be able to operate and serve, and to be sort of the hub of that community. And for our organization, moving down the path with them, that was really what was a key driver for us, was to ensure that both from a regional perspective, an operational perspective, and certainly a member service perspective, given its history, that they would have the ability to be able to look, out 15, 20 years and ensure, future sustainability. Because as a board and as a management team, their numbers are good today, but they realize that the runway is short, and the need to be able to do something is kind of when you have the option. And when you have an aspect of strength, and so be able to do this together has been quite enjoyable.
Thank you all. So I'm going to ask maybe a bit of a more difficult question. We've heard from various credit unions about challenges with mergers, right? That some have been very happy with mergers, others have said that the benefits or they haven't achieved their goals, or the benefits have failed to materialize. I'm wondering if you could speak to whether or not the mergers that you've been involved in have met the goals and objectives you've set, or if you're willing to share some of the challenges that you experience with your mergers. And maybe I'll start with Mike Schilling this time.
Thanks, John. So the most recent merger that I was involved in, there was definitely an event. There was a triggering event which a smaller single branch credit union, the board had made this decision, and I think it was the right decision. It was the right time, but there was an element of reluctance, and we were very, very clear to members about that. They had a really engaged membership. A really locally focused credit union that had some really innovative products and member segments that they had lots of expertise on. So there was obviously a fear amongst the membership and amongst the board that represented them that any merger was going to dilute what makes them special. And I think that's a good fear to have. That's a good worry to have as you go into a merger. But we were where we were, and we partnered up with them, I think, as the most likely and as the best option that they had to go forward. So we quickly tried to turn the narrative away and said, okay, well, we're here, we're going to move forward and propose a merger to our membership. What are the special things that we can preserve? What are the opportunities here? So Celina described a great the correct way to do mergers, if you like. You think about it, you think about the synergies, and you think about the way to go forward. This was slightly a little bit more of a shotgun wedding, but then we started to try to think about those things and make the very best of what we could do, and I hope we have. But mergers are expensive. Lawyers get paid a lot in mergers, and there's a lot of technology costs, and consultants get paid. They're distracting for management teams. They're hard to do. But what I would say, I'm glad we did this. The credit union that we merged with had some unique product sets, had some unique perspectives on helping people within their membership, and they're the things that we've tried to learn from and preserve as a joint organization and take forward. So there's a question of, there's a number of ways of calculating whether it was worth it, from a balance sheet growth perspective, from a member acquisition perspective, from a cultural perspective, and preserving what was built special. I think it's a complex question, but I'm glad in the end that we did it, because we as a joint organization certainly learned a lot from coming together.
Thanks, Mike. Mark.
Yeah, it's a really good question, and I think one of the things that I'm proud of from a Kootenay Savings perspective is because of its evolution over the many years, they've been able to really sort of retain that local presence in those respective communities to which we're brought as a part of now what is Kootenay Savings. And so the intent there around community, the intent there around presence, the intent there around ensuring that there are services available for those members and communities has been achieved. To Mike's point, some of the challenges, I use the merger analogy and compare it to the Canadian healthcare system. And every transaction, right, or every interaction is a financial transaction. The costs associated with going through this process is really extreme, and you have what I call those sort of predatory sort of advisory sort of groups that are just licking their chops when any opportunity like this arises, and really sort of make it challenging. It's challenging from a management perspective. It's challenging from the demands that the regulator are putting on even the Competition Bureau and some of the processes that you have to go through there. Even though at the end of the day, I think there's a clear understanding that it's the right thing to do for the right reasons to ensure long-term sort of sustainability. And I would say one of the big challenges I think is when you're addressing it from a member perspective. It's trying to address every member's issue relative to a merger, and that becomes quite difficult to do when you have mergers that have certain expectations, individual expectations, that don't really understand what's happening from a financial services landscape, don't really understand what's happening from a competitive perspective, and really just don't want to see any change. Whereas change is a necessity as you start to move through this because of the reasons of why you're ultimately coming together. So I think that becomes quite the challenge. And also as well, we've had lots of conversations with lots of credit unions, and I think there's still a big division at the governance level. There's still mindsets around what organizations would call themselves kind of fiercely independent, and don't want to be doing anything, but at the same time, they'll at some point get forced into something, and then they have no leverageability. And so you're trying to articulate opportunities that can present themselves while organizations have the ability to sort of work on respective solution and true partnership versus having to ultimately react. So that proactiveness versus reactiveness, I think, is something that we don't see a lot of in the credit union system. Is typically only being done when it has to Mike's point, out of necessity at times. And we're trying to sort of engage in dialogue and conversation to allow, from a governance perspective, individuals to be able to see what that potential sort of runway is, what's coming sort of down, down the path relative to pressures on the system that's going to continue to sort of, get at our core operating model from what we've sort of enjoyed in the past.
Thanks, Mark. Celina, challenges.
Yeah, appreciate the question. So we're still early on in our journey. Our legal date isn't until January 1 of 2026. But what we can see ahead of us as far as challenges is the balancing act, as I like to call it. So being able to integrate seamlessly as much as possible so we don't disrupt our operations while still continuing operations at the level of expectations that our members have. So as we're transitioning and coming together, we still have to keep things running as smooth as possible for our members. Further to that, I think it's a theme that's already been shared by Mike and Mark, is just the people aspect. So the cultures, bringing our cultures together. I think there's a real opportunity at the core. We are all credit unions. We understand the importance of membership and why we're here, what's our purpose, as well as those 7 cooperative principles. But how do we bring, people together, and in our case, 3 different credit unions together, while honoring the past, but having that bold thought process to move into the future and to create a net new, while still respecting what made us great and what brought us together to this point in time. So I think it's balancing all those things.
Okay, thanks. So it sounds like you've all identified that they're not easy, they're complex. There's a lot of challenges, especially internally. It's a big lift for bringing together different organizational cultures and dealing with the governance aspects and trying to communicate to members. But it does, and correct me if I'm wrong, sound like all of you sort of see, or at least perceive, that the benefits of this will outweigh the costs, at least in the context in which you are. Okay. So then I'm actually gonna turn to Mike Bouchard, and he might throw a wrench into some of the discussion around mergers. As I've had a lot of conversations with Mike. Really, I think, innovative thinker on a lot of the structural changes happening in the industry. And so I wanted to ask Mike, what do you think the traditional basis is for mergers? And do you think that premise is still sound? Or are there structural changes occurring in the fundamental business model of retail banking that actually might even potentially undermine the value of mergers?
Fantastic. So first, Dion and Marc-Andre, thank you for having all of us, and me in particular, and also for your continued leadership in our space. So thank you both for all the exemplary work that you do. So we spend a lot of time here at Kootenay Savings thinking about this, the hard question of the big topic, the hard question of, well, do mergers still resonate? And the big topic is, what is the basis of mergers? So I'm going to channel my inner Marshall Goldsmith by echoing what got us here most likely won't get us there, because we believe under Mark's leadership here at Kootenay Savings, that we need to look at this question as what is the basis of merging? Because we believe that there is a legitimate and reasonable probability that we could lose our so-called center of gravity. And I'll unpack a few challenges that we see. And I'm bringing a risk lens to this. So the risk lens is looking out from where we believe the industry and some of the profound structural changes that are taking place in retail banking in Canada, relative to where we are today and relative to where we've been in the past. And is the basis of previous merger activity, does it still hold up as we look to the future and some of these profound changes? So I think what we look at is, as we face the hard question of the big topic of merger, are we able to hold on to our center of gravity? And I think the first thing that we'd like to unpack is what we like to refer to as a bit of a potential challenge of identity. We think there's the potential for what we internally at Kootenay Savings call the dual drift, and that is the gravitational pull of becoming increasingly large. We recognize the potential merits of scale, but at the same time being, well, not just seduced, but being realistic about the lure of becoming increasingly tech-like. So here we have on one hand these two potential polar extreme, one of size and scale, and one of nimbleness, digital, and dexterity. So it's a very difficult challenge that we face. And on some levels, it reminds us of the 2001 to 2005 challenge that Blockbuster Video, I'm probably dating myself by bringing up Blockbuster Video, and the onset of the arrival of this impertinent interloper, the so-called Netflix. And many may not remember, but in 2005, Reed Hastings, the then CEO of Netflix, offered his company to Blockbuster for $50 million. And the Blockbuster CEO said, "We don't need you. You're just this afterthought of insignificance." And of course, that was a $500 billion blunder. So we recognize that we as a credit union system deal with these twin towers of digital and digital preparedness, and also scale and the challenges associated with that. And we think that this potentially, if not managed correctly, could create what we call that identity challenge. Of course, the dual drift has led us to our second challenge, and we like to refer to it as our operational challenge. And we've internally coined a phrase largely leveraged by the great American economist Pippa Malmgren, and we call it the techplexity. That is to say, an emergent level of almost hyperbolic complexity as a function of many technical skills, nuances, and attributes that increasingly all credit unions have to invariably face. And these technologies aren't just actual technical or IT systems. Inside of a credit union itself is a techplexity. You need to be excellent at liquidity management, ALM, AML. You need to be great at finance. You need to be great at HR. You need to be great at operations. You need to be able to manage your balance sheet on a calibrated basis so that internally you can operationally consume what you're doing in terms of managing your balance sheet, but also with respect to the capacity of your staff and the people that give life to your credit union every day. So you yourself increasingly are a techplexity, and then the credit union itself is nested inside of the market. And we look out and we see many profound structural dominoes that will slowly but invariably, inexorably be tipped over, really starting in fiscal 2026. I'm going to be using a lot of acronyms because we're acronym junkies, and I think everybody on the call will allow us to do that. We see the arrival of RTR, real-time rails, will begin real-time payments, and then we overlay that with ISO 20022, and we know that this isn't just a piece of structured data that we see, as Mark likes to say, every interaction is a transaction, and we see every transaction being an incredibly powerful, discrete informational asset. I would respectfully submit to everybody on the call, there's probably nobody on the call who can even approximately, I'm probably going to resent saying this, few will know how many transactions their credit unions do. And going forward, these become the lifeblood of your organization. So we see within the techplexity, we have to manage increasingly complex technical layers. And a techplexity is all these individual technical attributes, technical layers that are layered, they're connected, they're recursive, they're interdependent. And they create a dynamic that is quite unlike any of the individual attributes of any of the individual pieces of the techplexity itself. Our credit union and all of our credit unions are nested inside of this RTR, RTP, AI, soon to be open banking, which will beget open finance. And we make a profound distinction between open banking and open finance, and digital banking and digital finance are profoundly different. And then we see larger dated epochs unfolding over tokenized deposits. And of course, you then get into algorithmic finance. And so the twin challenges of our dual drift nested inside of the complexities, how do we remain a cooperative community-based credit union when we have to appreciate the merits and harvest and monetize the structural challenges of scale, whilst at the same time creating that digital capacity that we so invariably need? And digital isn't just, remember, digital begets then computational finance, where we need to get better as credit unions, being able to reach inside of the gubbins, the market infrastructure, and managing all of our finances, because it begets the third challenge, which is what we like to refer to as a challenge of finances. We believe that this dual drift and this techplexity era is changing the fundamental physics of finance. And we call it physics because it's the canonical relationship between the structure, the movement, and the velocity of money. And what we see potentially happening with all of these new rails and all of these new technologies and all of these new connections, we see the potential for our underlying economic model in a credit union, the so-called carry trade, our lending and our liabilities and the relationship between the two. Many credit unions that are on this call, and many in the credit union space, will admit that if not 80, perhaps over 85% of our top line comes from net interest income. And when you start to have the relationship between a deposit and payment and then a liability and lending start to be pulled apart and start to be contested in ways as a function of open banking that we've never even thought of, where our deposit stack and our non-maturing deposits can potentially invariably start to price like a market security on a defensive posture to protect ourselves and our members and our liquidity from the predatory fintechs. All of a sudden, the spread between non-maturing and maturing deposits can almost collapse, meaning we could see significant downstream structural compression on our net interest margin. And the credit union system already has challenges with net interest margin. We can see empirically that we've grown our balance sheets, but we've not structurally gotten better at growing our net interest margin. And that's a secular trend. And increasingly, our thesis is that it will become a structural trend. And we believe that going forward, what's required is what we like to refer to as architectural coherence. And my final arc on this very brief dance through some of these structural layers is that we believe the past 15 years have been defined by what we refer to as administrative consolidation. And what we believe we're slowly but inexorably entering into is what we like to call architectural coherence. And so the future will be defined not so much by integration, but by architecting, by designing our credit unions so that we can participate in this new physics of finance. We can reconcile the challenges of scale and digital concurrently, where digital banking then allows us to functionally become fabulous at digital finance, where algorithmically we're able to translate community and cloud concurrently, where we can reclaim as a function of advanced technologies our center of gravity and allow us to use this new emergent market infrastructure to build a brand new conception of what it means to be a cooperative system and a community-based credit union, so that we believe the merger question needs to be re-evaluated, reframed, so it can ultimately be redeemed.
Thank you so much, Mike. So a couple of things that I just want to highlight in sort of what you said is that I think a lot of times that mergers are done as a way to sort of build or grow the balance sheet, right? And instead of sort of thinking about the fundamental change in terms of how banking is going to be done in an era where everything is becoming more complex. It's not just about creating a digital interface for your customer, which is, I think, what a lot of people think of as sort of the digital technological space. It's actually fundamentally rebuilding the entire sort of back end to be able to reduce the time it takes to kind of provide to make money, right? It's the evisceration of the net interest margin, right, is going to require a way of dealing with the rapidly increasing time challenge, as you refer to it, as the physics is changing, right? It's fundamentally the velocity of what is happening and how all of the systems are interconnected is something that we're only just starting to grapple with. And that the way that the system has been built and the way credit unions were built for a different era may not actually fundamentally help us in the future. And so I think that idea, right, is that if banking is fundamentally changing, right, and we're using mergers as a way of solving sort of the same problems, that may not hold us in good stead. And I think that these ideas are complex, but I think they're important for us to grapple with, and to think about how do we articulate this problem for all kinds of credit unions of different sizes, because it doesn't just affect the small ones. It also affects the large ones, and in fact, actually might even affect the large ones more as they grow, because they become increasingly tech-plex, which actually can make them more vulnerable even than the small ones in many ways. And so I think it's a really insightful set of challenges for us as we think about mergers. So then I want to talk about, are there alternative paths to mergers? Are there ways, or are there ways in which we can think about mergers alongside paths that might address some of what Mike is talking about as fundamental shifts in the nature of retail banking and the structure of finance and systems that we're operating in? And so for this, I'm going to go back to Mike and Celina and ask them if they've thought about these things and alternative ways that we might move forward. And so maybe I'll start on this. I'll start with Mark and go back through the other way.
Thanks, Dion. Yeah, I mean, Mike captured, I think, some, really sort of interesting points, right, around how do we sort of digest kind of, the environment today that we are in. And we've always, at Kootenai Savings talked about, it's not about whether, like, the question for us is not about whether we merge, right? But it's really around whether we evolve as an organization. And so if you look at, your stats around from, the mid 60s to kind of where we are today, but even if you just take it over the last, let's say 15 years, and you look at that significant consolidation in the Canadian credit union system, institutions have certainly grown larger, but the honest question that I think you have to ask is, have we become better, right? Did our returns improve? Has our resilience sort of deepened as organizations? Have we protected our margins in respect to, that ongoing sort of consolidation piece? Or did we simply get bigger and not stronger? And so when you look at, the first question around sort of mergers, and we all have respective history in and around that. We look at that and look at it from a perspective of saying, that many mergers likely in the last sort of era were likely more along the sort of defensive side, the reactionary side, not necessarily transformative side, right? And so, the ability to sort of absorb certain expenses, reduce kind of redundancies, I think, addressing regulatory expectations, all of those, were key things. And Mike Schilling's, points around, opportunity that would present itself, given sort of the ability to react. But we look at that as being, okay, well, that was respectfully potentially all about size. And we believe that the next 15 years is going to be, to Mike Bouchard's point, is going to be about architecture, right? It's going to be the fact that our, traditional cooperative business model, as we've known it, the spread on the funding, the lending is certainly, breaking down for us. And it's not necessarily because of competition in what we would, put into kind of the usual sense, but it's because of what we are and what we will experience. And Mike talked, about real-time payments, and the ability for that to eliminate our float fintechs and PSPs, the repricing deposits at machine speed, We're going to be dealing with that automation, replacing deposit inertia, loans being priced by algorithms, competing in transparent markets, members switching institutions with a swipe or an API call, and our cost of funds rising, even as loan yields compress. And so we look at this and say, this is not cyclical, right? This is not temporary, that this is actually structural impacts to ultimately our business. And ultimately, then that calls for, a different kind of answer. And, as Mike noted, the new strategic problem that we have to be dealing with and addressing, is things like latency, it's reflex, it's architectural coherence, data fluency, cyber system risks, algorithmic liquidity. We talked a lot about open banking, the regulatory compliance, the 2022. This is to us now the kind of the new basis for what we would say are mergers version 2, right? So cross-institution intelligence is now more important than cross-institution size. And this is a perspective that Kootenay, is out there, is articulating, is engaging with credit unions, is writing papers on, and getting to the place of being able to articulate. And when you look at what traditional mergers have done in the past, it doesn't give you those two things, right? It doesn't give you that cross-institutional intelligence, and it doesn't give you more mass, it gives you more mass, not more reflex as a result of that. And so we can no longer kind of just scale or merge to create scale. Scale still matters, but it's got to be the right kind of scale. We look at balance sheet scale being kind of yesterday's problem, and we look at computational scale is today's problem, and predictive scale is going to be tomorrow's problem. And so we need to merge or federate in that case for intelligence, right? And so when we look at what we would call at Kootenay sort of the third way, we look at that as being kind of a new model of cooperation, and that's around purposeful architecture. How do you tackle that community roots and computational reach, which is extremely important for our values, right, as cooperatives, that local governance and shared capability, physical presence and digital fluency, autonomy and federated intelligence. How can we collectively start to reconcile that branch and blockchain, right? The community and the cloud, the purpose and precision. And that's what we believe the next sort of 15-year iteration of credit union evolution ultimately is going to be. And so we've been spending quite a bit of time here at Kootenay building a model called Unify, which stands for Unified Financial Intelligence. Not necessarily as a merger alternative, but more as a merger evolution. And so it becomes for us, Unify, a real sort of practical expression of that purposeful architecture, right? So it looks at how do we come together as organizations? How do we look at the development and the building of shared technical chassis, right, inside your operation, your organization? How do you look at shared payments and open banking integration, real-time treasury sharing and shared analytics, AI, governance intelligence? We talked a little bit about governance on the front end of the conversation, shared risk and compliance infrastructure. And so it's important that, from a unified perspective, that what we're driving that preservation of autonomy, but providing, the architecture that no single institution on their own can build alone. So it's not a consolidation of balance sheets. It's more of a federation of capability. And it gives us what we believe the next era of operation for credit unions is going to require. And that's going to be around coherence. It's going to be around speed. It's going to be around intelligence. All of that without sacrificing that community identity. And so, moving forward, we got to start to ask ourselves, as a system, and as we think about the future of mergers, not necessarily how big do we need to be or how many credit unions ultimately will be left, but more we need to start asking questions around how fast can we sense and respond to the movement of value? How do we protect purpose in real-time system? How do we build shared capability that no one can build alone? And how do we design architecture that keeps community relevant? And so we believe that those are the real sort of merger, quote unquote, questions of the next 15 years. And we've sort of termed a position around that the future of cooperation is not going to be defined by how many credit unions remain, but by how many credit unions ultimately are connected. And so, our Unify process has allowed us to be able to have some real good dialogue. We're building sort of, partnerships as a result of that. And we have the ability ultimately then to start to leverage those in a different fashion than what would be normally sort of viewed, as sort of the normal process of merging.
Thanks so much, Mark. Celina, how are you thinking about some of these other challenges that have been raised in terms of like beyond mergers or in concurrently with mergers? What are some of the things that you're thinking about?
I think it's drawing on kind of what was our area of strength, our ace in the hole, if you will, is as cooperatives, we cooperated on things. So it's just kind of going back to the basics. Where can we cooperate? It's a bit of a build on what Mark was sharing, where we can build something solid like a payments infrastructure, that if we can build extremely well and we can innovate as a system, we all get the benefit of that. And then we can still focus on our core operations, which is on how we want to deliver to our local markets, how we want to show up in our communities, which is really that interaction with the member. The payments, as an example, has to be there. It has to be delivered on an even playing field. We can't fall behind. We at one point were innovators in this space with the first ATM, and I've got to give a shout out to Sherwood Credit Union in Saskatchewan, Regina, Saskatchewan, that created the first ATM. We used to build unique things. Geez, I'm starting to sound like Mark Carney. We used to build things in this country. So, okay, let's take a riff on that. So where can we join forces to build something unique where we can say the credit union, we do first, and we do it extremely well. And as a cooperative system, we can harness all that talent, all those resources, because we know this is not going to be inexpensive, but we built it once, we innovate it once, and we kind of share that out, because that only strengthens the system as a whole. And then we look how uniquely we can show up in our communities and add that value in a way that is meaningful to our members within the context of our province, or whatever context. If you're federal as well, you can focus your energy on that, knowing that the backbone, the rails, is solid, and continually innovating so that we don't have to manage all of these things. Because I do agree with Mike and some of the things he's saying. As you get larger, you have to deal with more of this complexity. Where do we drive value, and where do we need to show up uniquely, and where is it just plumbing, but the plumbing needs to be super solid, right? You wouldn't want a house that's beautiful but the plumbing doesn't work, right? It's kind of critical, but you're actually wanting to enjoy the beauty of it or the functionality of it. The key things like plumbing just has to work, and if you can innovate on it and people are excited about it, that's where I think we can draw value.
I love the thinking about finances, plumbing, or the sort of infrastructure as the plumbing. I love that analogy. Yeah. Mike Schilling.
Yeah, thank you. So yeah, some sort of exciting developments. I think this is a really interesting time to work in our system. So out here in BC, there's a group of 11 credit unions, and we've given ourselves the grandiose title of the G11. I think Mark Carney was hosting something in Canada when we formed, so we called ourselves the G11. And we're working on a new model, so a model which doesn't exist today in BC. Doesn't exist under existing regulation and legislation, which we're loosely calling the federated model. So this will be a federation of independent credit unions, and it's trying to answer some of the problems that we keep coming up against. So I'll go back to that 3,200 credit unions. 95% of them no longer exist independently, but 5% do. And maybe there's a reason for that. Maybe those 5% of credit unions have a special connection to a membership group. They do something that someone else doesn't do, whether that's geographically or in other ways. And we're all amongst those 5% of credit unions, right? We're all the survivors here and have come through to this. And so I certainly don't disagree with the advantages of scale. Achieving balance sheet scale is a huge advantage. I would love to wave that magic wand for myself. But as a credit union, Community Savings hit a milestone last month. We reached $1 billion in assets for the first time. But when we're celebrating this milestone with members and thanking members and celebrating the milestone with the team, our message is as we reach that size, we're actually going to start to think small. let's keep thinking small and resist that temptation to evolve into something that might move you away from members. And there's a sort of natural atrophy that can happen in there. So whilst I think we all recognize the advantages of scale, balance sheet, technology, procurement, talent acquisition and retention, all of these things. I do think we overvalue it, or at least we undervalue the other side of the equation. And I believe as a credit union that we really only have one asset, and that is our connection to our membership. That's our definition and connection to our unique membership group. Lots of our competitors outside of the credit union sector and the broader financial services can do scale. They can do technology. They can go and hire the smartest people. What they can't do is replicate our connection to our membership. So our question amongst this group of credit unions in BC, and we're all under $1 billion. There's about 11 of us, 11 to 16 in the group. We're trying to co-opt a few more in. So our question is, how do we get both? How do we get the best of both worlds? How do we get those advantages of balance sheet scale, the ability to procure technology together, retain and attract talent, etc. However, keep that connection to our membership, and that's what we're trying to build under the federation. And there may be more than one ways to do this, by the way, but we're and this is a half-baked cake as I speak to you at the moment. We're still kind of working on exactly the legal structure and the way that would work. But it really is about retaining within the front office those ideas around market definition, about product development, about product decisioning. There's a reason that you're in that town for in the first place. There's a reason that we built a credit union to serve that membership, and if we lose that in a sort of blended merger, as the pressure's always there, and Celina, this is you guys are doing a merger. It's certainly not lost on you. I don't know it intimately, but I'm a distant admirer of Conexus, and but the pressure's always there. The pressure is always there to move away from your roots. It's not necessary, but over time that pressure is quite a push. So that's what we're trying to avoid. We're working really well with the regulator at the moment. We're working with other credit unions who are part of this group or not part of this group within the system, to say, is there an alternative? So when your time comes as a credit union, which might be tomorrow, it might be in 5 years, it might be in 10 years, do you have an alternative choice to merging up to a big credit union, or could you join a federation of smaller independent credit unions? And that's what we're trying to develop at the moment.
So this is great. We have time for some questions from the audience. And right now there's a bit of a heavy theme coming across on just what you've all been talking about in terms of cooperation among credit unions, a federation model or a federated model, as opposed to this idea of continued mergers and sort of getting bigger by scaling up rather than scaling across. And so I have a question about this. Celina, I think, rightly pointed out that historically, this is actually how the credit union system did this, right? Was cooperating through the centrals, right? Which have been more or less being pieced apart for various reasons. And so the question that somebody is asking is, is this federation approach a possibility, or is merger the way forward? And I'll preface this as well by saying that one of the concerns that we've heard in the study that we're doing on the future of small credit unions is that small credit unions get together, much in the way that Mike is talking about, 11 under around $1 billion get together and figure out ways to cooperate, and then they start merging and they get bigger and different needs, and there's a breaking apart of sort of the need for cooperation. And so I'm wondering if all of you could sort of speak to that. And maybe, Celina, I'll start with you, because you mentioned how cooperation among cooperatives is so important, but also Conexus is one of the larger ones, right? And so how do you see this? What do you see as the challenges of this kind of a more federated kind of model rather than continuously scaling up?
Yeah, I think it's important, but Mike hit on it. It's the identity you have to deal with that. And that's the hard thing, is not losing your identity. Like even at Conexus, yes, we're a product of many mergers. How we looked at our members and the communities we serve has just gotten bigger. So we all started in our own communities and recognized through the movement of people and the introduction of technology, the definition of community has really gotten large, right? People move around all the time. They live in a community, they go to university in a different community, they move. So it's just gotten bigger. So recognizing that we need to be at a certain size to compete with our large charters. That's really what we're looking to do, is that market share over time. And Saskatchewan had a position of strength At one point, at last I recall, it's like a 43% market share. We're slipping down into the low 30s. And I say to myself, what's happening, right? Is it the proposition of the value prop that we have for credit unions not resonating anymore? Are we losing our relevancy? Is it just we have these large players in our market that are just big and get everybody's attention? So not that you want to take a bank model and apply it. I think that's the worst thing to do in a credit union environment. But the scale and the size gives you a certain presence. And when you're able to have that presence, you're able to then optimize on the scale part. So it's not just about the merger. Yes, you have a nice balance sheet on day one. The real thing that's missing there is how have you optimized that scale to draw value and benefit to your member? At the end of the day, that's what matters. And that's the challenge through a merger. But that size, it does stand out in a marketplace of giants, and our economy has changed over time, right? Our competitors are not getting smaller, they're merging as well. So it's not something unique. So then you're starting to compete on a scale of really large competitors, and that is where the market share is moving. It's not going to credit unions, it's going to your large competitors within that chartered space. So there's a perception there of the market of what they can offer versus a smaller entity. Like there's a interplay that's happening within their consumer because they are bombarded with a lot of information coming at them. And of one thing I've got to say, the charters are marketing geniuses. They're really good at what they do there. And I think with credit unions, we just have to give ourselves a lot of voice to say we are truly an alternative and we can stand toe to toe. So large enough to deliver, small enough to still know what matters to you, and innovate at the level that would actually drive value because we're still here to listen to you. So
thanks so much, Celina. I have actually maybe a bit of a twist on it for Mike and Mark to ask this question. So somebody has pointed out that Desjardins in Quebec provides most of that back-end service to their cases, right? So a lot of that is, and through sort of this federated model, there's other examples like the cooperative retailing system that does something similar. Is this kind of thing possible? A federated model, because both of you have touched on it, Mike and Mark, in different ways, a federated architecture, sort of a federation of starting out with this group of 11. Do you think it's possible that there could be a complete plumbing, as Celina talked about, built, as part of that federated structure that all the credit unions?
can I just offer one thing, Dion?
Yeah, go ahead.
What I'd like to love that example. It's the Desjardins brand, though. That's clear. There's no market confusion. People know that it's Desjardins. So there's something with recognizing that brand and understanding what it stands for. But thank you.
Yeah. Mike, Mark, do you want to speak to
that? It's certainly an aim of it. I think, if 11 credit unions come together over time, let's find those efficiencies, let's find those, back office efficiencies, let's call it in terms of the plumbing. I think that's sensible, but I think in the past it kind of dominated the thinking of it. When you went out for a merger partner, let's go find someone with the same banking system as you, because that'll make that easier. We're fortunate now that some of the technologies coming through with APIs and digital twins and things like that mean that actually doesn't need to be a day one activity. Now, personally, I think I've got no argument against back-end efficiency. And if I'm ever smart enough to understand what Mike and Mark are talking about, I'll buy 2 of them. It sounds great. And so I'm certainly not arguing against that efficiency, but it can't be the lead. It can't be the lead strategic thinking of what you're going to build. But I do think it's possible. We, as the group of 11 out here, we did a study on Desjardins. We looked at what's been happening in the Atlantic Centrals. We've looked at what happens in Europe, in Germany, and in different sort of federated and cross-supporting models. And what we're building is a little bit different. Just because Desjardins came up, one of the thing is kind of less centralized control over obviously brand, but some of the product decisioning and innovation that I think Desjardins kind of came together in the 70s in the way it is now with the cases, and over time it's evolved, right? But step one for us is kind of looking a little bit more with a little bit more devolution within the model, which may and will inevitably evolve over time into who knows what. We've got to leave some problems for the people who come after us to solve, right?
Mark, do you have any thoughts?
Yeah, I think and agree on Celina and both, Mike's comments around that whole sort of process kind of evolution, right? And so, when we think about that, what will ultimately success look like, and whether that's sort of in a federated context, whether it's through a kind of an ongoing sort of process of merger, we see the evolution of what we see as clusters. And so, we also believe at Kootenay Savings in the inevitability of what we call credit union singularity. Now, that doesn't mean one credit union in Canada. That actually means, a number of different sort of clusters of credit unions working together that are interconnected, to address sort of, that system capability, that whole sort of process of being shared from an architectural perspective, in maintaining that sort of local autonomy, preserving it, addressing the needs of that local sort of member that we talked about. How do you maintain that sort of community rootedness? But at the same time, you're drawing upon, an aspect of collective intelligence. And so, there's going to be various sort of evolutions of this over time, but I think it just becomes more of an inevitability that we're going to start to see more and more of this integratedness around technical capacity, advanced technical capacity, that's going to be required for credit unions to be able to continue to operate in the manner to which they want to operate today, given the fact of we are up against organizationally from both a competitive landscape and a changing of significant sort of financial services landscape.
There's a lot of questions around the regulators and the regulatory environment. And so from your perspectives, how are are the regulators going, like, how could they be supportive of, or how are they possibly barriers to these kinds of solutions? I mean, are they really kind of the push behind the mergers, right? Is this like sort of coming from the regulatory space and maybe not the best in terms of like thinking about what makes credit unions different? What's your perspective on that?
Well, maybe I'll just take a shot because I didn't take my audio off. So I actually think it's a great question because, over the last, I would say, 3 years, Kootenay has been very active with our regulator. We've had different sort of iterations of leadership around a regulatory table. It's taken sort of a different kind of tone over the last year or so. And in fact, the regulator has taken a pretty active role in working with the collective system on trying to shape a vision ultimately for the system, moving forward. And so there are complexities in and around, the different sort of models. Mike Schilling just talked a little bit about, some of the things that they are going to require as that group of 11 in and around legislative change. And so, they will ultimately need aspects of support and somebody ultimately to be championing that. But the fact that they are active and engaged in conversation and dialogue, I think, is a very important aspect because that doesn't happen, everywhere. And I think it's also important that, as we come up with ideas and thoughts, that we're sitting down and sharing, with the regulator and looking at the regulator, not as a potential sort of barrier to opportunity, but more of a partner to opportunity and helping us to sort of shape what that future state ultimately can be. So we're seeing a lot of activity in British Columbia in and around that. Of course, there's things that are happening from a political perspective around the potential of cross-border operation. There's conversations that are happening with, a number of different provinces that we may actually see that would potentially then impact some activity around federal continuance in a very positive way. So, the more that you're kind of aligned and connected, I think, the more that you can continue to take, steed from a regulator in a manner that can work in your favor.
So maybe I might turn it to Mike and then Celina for just a couple of last thoughts on anything. I realize that we have come almost close to the end of time. So Mike, any last thoughts about any of this? Regulation, cooperation, mergers, and then...
Well, I'm not sure if our regulators on this call or might listen to a recording, so I'm just going to say the regulator has been enormously helpful, probably the best regulator I've ever worked with. No, you've got to, I think, genuinely here, and the regulator has prompted a discussion here in BC, but it's important, and we as a group of 11 credit unions are now taking the reins to make this a system-built approach, and the regulator respects that. They're certainly a critical partner. We need to satisfy their requirements, but they respect the fact that we don't exist to be regulated. We exist to serve our members, but we need to do that within a regulated environment. So we've got a window of opportunity here in BC that we're really working towards.
Celina.
Yeah, I would say within the Saskatchewan framework, we see our regulators as partners, equally responsible to ensuring the financial soundness and safety of our system. So we have a very good working relationship, and they believe in credit union self-determination. And in their role to ensure the soundness and safety of the system, I think they're performing the role effectively. And I can say we have a very positive and effective relationship here in Saskatchewan.
Excellent. Well, thank you. Well, I might just end by saying if you had told sort of anyone in the mid to late 1930s when credit unions first spread to Western Canada that today we would even have built these community-based credit unions worth billions of dollars, no one would have believed it. And I think they would have struggled to see how these financial institutions would even survive. And I think people are still saying the same thing today. But credit unions defied all odds then, and they can do it again now. As I started at the beginning saying, it can transcend boundaries that underline cooperation in so many areas of our lives. And so we're going to be continuing these conversations. We're going to hopefully have more webinars around this issue, especially as our study comes out as well. So I want to just thank the speakers for sharing their time and expertise, and to all of you who are joining this timely panel today. We also gratefully acknowledge the many credit unions and co-ops who support our work at the Canadian Centre for the Study of Cooperatives every day. Natalie is going to share a link in the chat with the upcoming events that we have at the center as we draw close to the UN International Year of the Cooperatives. We have several very exciting events, and so she's going to put a link in the chat. Please go visit it to see where you can continue to connect with the Canadian Centre for the Study of Cooperatives. Thank you all.